So hi there, it's Nathan Copeland with REMAX Rouge River here in Northumberland County. Today I'm talking with Joel Scott from Neighborhood Dominion Lending Centers. Hi Joel, how you doing today?
Nathan, glad to have you. Glad to be on board. It's pretty exciting. Thanks for having me.
Oh, terrific, terrific. As most of you know, the real estate market in Northumberland County has been extremely hot lately, and this year has been unprecedented as well as last year. To give an example, if you bought your home in 2014, and this would be an average detached home, average price detached home in anywhere in Northumberland County, you would have paid $290,000 for it. And at the end of 2020, the average price would have been 547. So we're talking an increase of over $250,000 in value just in 6.5 years. This year so far, and we'll see how if it continues, the average price is $660,000 for a single family detached home in Northumberland County. That means in a 7-year period, your equity is increased by $370,000, just substantial.
Wow.
I bring this up because clients have been asking me, is there any way for them to possibly tap into this equity if they wanted to get into the investment market in real estate, or maybe even buy a recreational property, a cottage property? So I thought I would invite Joel on to basically talk about this at a high level and based around 3 questions. Do you think it's a good idea, Joel?
I think right now, especially with the cost of borrowing from lenders, and we've been in a historic rate market where interest rates have never been this low, especially for this sustained period of time. And if you can borrow money at 2, 3, 4, even 5%, put it into a real estate asset that is going to grow at the growth rate that we're seeing now. And even if you look at real estate over a long period of time, over a 100-year period, like it still grows anywhere from 5 to 7 or 8%. So you're putting money into a growing asset. And if you can leverage the equity in your home to use the bank's money to make money for you and your family and create wealth, it's a principle I wish I was taught in my 20s, to tell you the truth.
Absolutely. So let's talk about it. So to give you an overview, we're basically going to ask you, Joel, 3 questions. One is, how do you go about determining the equity you have in your home? Just what is that process? Secondly, once you know that, what are the programs and products that main lenders or primary lenders offer to allow you to access that equity, to use it in a real estate purchase? And then finally, the third question will be, once you know what you can do and you have found a property, what are the lenders looking at in order to make sure you qualify for that purchase? So we'll start with the first one. Joel, how do you go about determining, let's say, the equity in your home?
Equity in your home generally is determined by 2 things. One, the amount of mortgage or any encumbrances that are owing on your home. And that could be home equity lines of credit. It could be your existing mortgage. It could be any other second mortgages that you may have, anything registered against the home. And then we take that amount and compare it with the market value of your property at that time period. So the market value can be achieved generally in 2 ways. We have some lenders that will do what's called an AVM, or an automated valuation. And then we have a formal appraisal, which is done by a licensed appraiser. And the cost for the appraiser is generally anywhere from $350 to $450. So to find out the actual market value of your property, the appraiser will come out. They'll do an appraisal of your home. In COVID period, they don't go in the house. They'll do an exterior look. And then what they'll often do is they'll ask the homeowner to do a video virtual tour with them, and then take some pictures, send the pictures back, and then they provide the appraisal report. And they take your home and compare it with properties that have been sold within your area or comparable properties in your area within 60 to 90 days. And that gives them an accurate market value of what the home's worth. So if you've got $300,000, for example, in home equity lines of credit and mortgages on the home, but your property is worth $700,000, then you've got a $400,000 equity stake in your home. And that's how people can find out how much they may have available to borrow.
So in simple terms, using the number, if it was $700,000 determined value of it, and you add all of your mortgages against it, say it's only one mortgage, and that mortgage was current balance to pay it off would be $300,000. They have $400,000 for the equity, as you said. And how do the banks look at that in terms of what they're willing to lend you against that? Or let's go right into the second question. What are the programs or products they offer to allow you to access that equity? And what percentage they allow you to access?
Well, let's stick with the example you just gave, Nathan. With a $700,000 home, Assuming there's three types of lending. There's prime A lending, which is credit scores above 680 generally,
Okay.
with steady income and low debt ratios. There's B lending or alternative lending. That's for people that may have weird income situations, might work multiple jobs and have varying income that comes in and out. There's different ways of qualifying income in a B lender situation. They'll also
Okay.
accept people that have got credit bruises. They'll also accept higher debt ratios if that's the case. So the amount of equity and the reason I bring this up is because the amount of equity you're allowed to access will depend on what level of lending you're at. So if you're at a prime A lending space, which
And let's
most
stay
people,
there. Let's kind of keep it to the A lending for this conversation.
sure. So
Just
if you're in
make it
the
simpler.
if you're in an A lending situation, generally you can access 80% of your home's equity. So on a
Okay.
700 or on your home's value, sorry, on a $700,000 home, you could refinance that home up to 80%, which would be 560,000. So if you had 300,000 outstanding, you could take out an extra 260 that you could use for investment to either invest into real estate or
Okay.
anything else you want to use it for. But real estate seems to be the way to go.
So that would be one method where you just refi your existing mortgage to current market value at 80%. Are there other products, maybe lines of credit, and how would that work?
It's funny because I just had a client I dealt with this on the weekend with, and they were looking to see if they could get a mortgage on a cottage property.
Right.
And those
Good
mortgages,
timing.
yeah, and those mortgages can be a little bit sticky because location is a big issue, water source is a big issue, heat source is a big issue. There's a number of factors that come into play in a cottage mortgage. And they, income wise, they qualified for everything. They were prime A lending. And midway through my sort of evaluation conversation, they happened to mention that they've got a home equity line of credit attached to their house for, they've got $450,000 on it. And I said,
Okay.
well, if you've got that sitting there up against your house, you could take money off your home equity line of credit, buy the cottage outright, and now you don't have to worry about paying for legals. You don't have to worry about appraisals. You can put a cash offer on a property and use your home equity line of credit. And ultimately, that's what they chose to do.
So a line of credit, you can apply for that now or after you're in the market. But what kind of rates would generally be associated with the line of credit?
Line of credit is depending on the lender and the institution and your credit. It's generally prime plus 1 or prime plus 2 in this marketplace. So if current prime lending rate for most of the banks is 2.45,
yes,
add a percentage or 2 points to that. So you're looking at about 4.45 for the line of credit.
still very reasonable, especially for a recreational property or an investment property.
Oh, absolutely. Absolutely.
All right. So you've got your appraisal. You've determined the equity you have on your home. Now you're looking at either a refi to take that equity out in cash or possibly a line of credit. And now you're in the market. And I'm out with you looking for, let's just start with single family homes or condos to purchase as a rental property.
Yep.
Okay, as an investment. And the bank has told you, how do they go about qualifying initially to find out how much they can afford? Then what are they looking at after that?
So first thing, I think there's a couple of factors to take into play. First and foremost, if you're looking to buy a rental property, you have to make sure that the rental unit is legal. And if it's if it's a standalone property that you want to rent out the home, well, then it's a legal rental. But let's say you're buying a property that's got a rental unit attached to it. You want to make sure that that rental unit is up to code and legal. Otherwise, they won't qualify it.
Gotcha.
So, but we'll use the purposes of just buying a second home, like a standard home that you want to rent out to a family for that case. So the banks will look at location. They'll look at your type of income. They'll look at your credit report and your credit rating. And they'll ensure that all legals are up to all the property is up to code. So when they're qualifying that to make sure, they want to make sure that you can carry the property or carry the payments on it. And depending on the lender that you go to, there's generally 3 ways that they qualify for rental properties. The first way is what they call 50% of the rent, where they take 50% of the rent involved and they just add it to your income. So if there's, if it's a $2,500 rental unit, they would add half of that to your income and it would boost your income to see if you qualify that way.
Gotcha.
Some lenders will use what's called a rental worksheet. And this is basically, I don't want to say a balance sheet, but it basically determines the cash flow of the property, what's coming in versus expenses going out. Yes. And then they'll take the income. If it's a positive cash flow, the income goes in your favor. If it happens to be a negative cash flow, then it will go in your liabilities and count as a debt payment towards that. So it also helps determine whether or not it's a solid investment as well too. And the third method is called rental offset. This one's a little more complex. The standard is basically an 80% rental offset. And it's used by the insurers like CMHC and Canada Guarantee and Sagan when a client's buying an owner occupied property and they want to add another rental. So they'll take 80% of the rental income. They'll calculate the cash flow of the rental property, subtract the principal, interest, taxes, and heat. And then if there's negative cash flow, that gets added as a payment in your debt servicing ratio.
Gotcha. So if you've got a reasonably low mortgage in your existing home and you find something that is of reasonable value in today's marketplace, which is probably going to be in the 500,000 range, it's showing a neutral or slightly positive income, then they're more than likely going to lend against that. And what kind of down payment will they be looking for?
So anytime you're buying a rental property, you need a minimum 20% down payment.
Okay.
So when you're looking at how much equity do I take out of my house, if you're buying a $500,000 property, you're going to need at least $100K to put for down payment. And then you don't want to take some extra out for closing costs and whatnot. But for any legal rental that you're going to rent out with lease agreements or tenant agreements, you'll need a 20% down payment minimum.
Okay. Okay. So if you've got a really solid income, where you're making 6 digits or multiples, and you've got $400,000 worth of equity in your home that you can tap into, you can use that for 1, 2, or 3 potential rental incomes at $100,000 down, as long as your ratios are still in line.
Correct.
With those mortgages.
Correct. And what we would look at is we would look at finding a lender that would best qualify. Do we use the rental offset? Do we use the rental worksheet, or do we use the 50% income? It would depend on what lender we select. We would try and find a lender or figure out a way to get qualified as much as you could qualify for. So maybe you qualified for 3 properties, but not 4. But now you're still looking at 3 properties that you could carry along with your existing debt ratios and your existing mortgages when you rent those out. So you're right. You could, if you had that much equity in your home and you wanted to take out $400,000, as long as the debt ratios work, you could go and make the 4 separate purchases if you'd like to.
And with the real estate market continuing to increase substantially like it has been, and with the historical low rates, every situation is unique, mind you, but it might actually make more sense to buy 2 or 3 versus putting 40% down on one home and keeping your mortgage low.
With money, with borrowed money this cheap right now, Nathan, you hit on a good point. Because if you put 40% down payment on a property, because maybe the only way I would recommend that is if it was an absolute necessity to get the property qualified. If if money is available to borrow at the cheapest that it is now,
yes,
you want to put the minimum amount of down payment down, because cash is king, and that money that you're going to have cash handy, you can take and put it somewhere else in another investment or save it for another property. And we would try and get you qualified with the bare minimum down payment, because keep in mind, if you're buying a rental property and you're putting, say, 40% down on the rental property, you've tied your money up into that property that someone else is going to pay the rent on. They're going to pay the mortgage down for you.
Right.
And with money being this cheap, obviously you want to put down the bare minimum, borrow the bare minimum, so that you get the maximum equity of the home as it's being paid down by your renters.
And conversely, if your ratios don't match up to a standard 20% down payment against that mortgage, then you could go ahead and do 40% if you have that equity.
Correct.
Have the mortgage costs down, your monthly mortgage payment down, and that allow you to qualify. In 5 years, start the process over again, maybe sell the first investment property, and then before you know it, this is very good, I think, for the before 40 crowd, if you will, the millennials and up, it's a way to get in the market.
You actually, Nathan, you bring this up, and I joked at the beginning of this that I wish I knew this when I was 20, but by taking equity out of your, getting into the market is the first and foremost thing, because once you're in the market, now you're in the game.
Yes.
And as you build your equity in your property, to take equity out and buy a property and then repeat that process, if you're a young person in your 20s or 30s and you repeated that process every 5 to 7 years, or whatever your income would allow, or whatever your qualifying would allow.
Absolutely.
If you look at, by the time you're later in life, 50, 60 years old, maybe 70, and you have a suite of 10 or 11 rental properties, you now are sitting on a whole bunch of assets that somebody else has essentially paid for, because you've used borrow money to buy it and somebody else is paying it down. You haven't really put any of your own money into it per se. And now you've built a wealth portfolio that when the time comes to sell those properties and take your profit home, you've built yourself a pretty handsome retirement fund. And that's, like I said, that's why I said in the beginning, I wish someone had told me that in my 20s. I would have started that plan much earlier.
Well, I'll wrap up with one more thought, and that is, just to make sure folks understand, is when you purchase an investment property and you take a 5-year mortgage on it, at the end of the 5 years, you've made money potentially 3 different ways. If you were to sell that property, number one, if it's cash flow positive, a few $100s a month, call it $2,000 a year, that's $10,000. Not substantial, but not insignificant. If you bought it for 500 and then your cash investment was 100, so your mortgage is 400,000, you've invested 100,000 cash. Now you balance your mortgage is closer to 320 because your renters have been paying it down. The market has went from 500 to 650, and you just made $270,000, if I did my math right quickly, on a $100,000 investment over 5 years.
And when you look at that from a percentage standpoint, try and find me an investment somewhere on the planet that if you go and put a mortgage on a home, and let's say your renters are paying down the mortgage by 5% a year,
yes,
while the home is increasing in value in this market, 15, 20% crazy rates, that's a 20% net return on your money. Where are you going to find that in many investment cases? Not in a savings account.
No. Well, I looked about a week ago, I was just looking at the average return on the S&P and a few other gold and one other, I forget what it was off the top of my head. And Northumberland real estate was outpacing it in terms of growth. It was amazing. Well, Joel, listen, I don't want to take a whole lot more of your time. Hopefully this has been very useful, and I appreciate your time. And if folks want to reach out to you to talk about any kind of mortgage product, how do they get hold of you?
Nathan, first of all, thank you for having me. And it's really nice to meet your online community, because I know you guys have established a tremendous following online. So I'm really grateful for the opportunity to chat with those people. If people have questions about finance anytime, they can reach out. You can find me on social media at Joel Scott or Joel JM Scott for my Instagram and Twitter. It's easiest too. You can just go to my website, joelscott.ca. All my contact information is there.
Perfect. Thank you very much. And if you're ever looking for real estate services, you can find me as well at nathancopeland.com, or our Instagram presence is Copeland & Co. And I work closely with my wife and partner, Lori Copeland. Joel, again, thank you very much, and hope you have a super week.
Thank you, Nathan. Have a great weekend.